Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com, here with a Forex strategy video in which we'll discuss the market moving potential of event risk. Now, I know that we just passed the non-farm payrolls, the expectations were exceptionally high, and in fact the outcome of the data was exceptionally remarkable, and yet the impact that we would be met with was somewhat contradictory to the expectations and more restrained than we could have otherwise developed. Now, this is going to be our running example, but we can always use this process and look at the market in this way to understand why we have maybe major event risks, such as the upcoming week's major docket items, or maybe we're talking about a central bank rate decision, or numerous other indicators and events that are scheduled and have historically been market moving, but we come up to it and it ultimately does not move the markets with the volatility we presume. All right, so heading into this past session, this final session of this past week, the non-farm payrolls report, the labor report from the United States, was without doubt one of the top event risks for the entire week. And certainly it taps into some of the major concerns that we've had, not just for the dollar and U.S. markets, but globally. All right, so it did have the impact, the influence, the clout to truly pick up the markets, to improve volatility or increase volatility, and potentially generate a possible trend. However, that's an optimal observation. All right, optimal scenario when the markets would be exceptionally sensitive to the major event risk, but we need to talk in terms of probability. It's not going to be optimal, nor is it going to be the most dismal. You're going to have something that is more realistic, more in the probable scenario, more in the normal segment of market moving. All right, so that's one consideration that we have to have. It's always important also to establish whether what we are coming up to in terms of event risk, whether we are talking about Thursday's Bank of England rate decision versus the Treasury growth forecast, or the ECB rate decision that we had on that same day, the non-farm payrolls obviously from Friday, or maybe next week we're talking about the trade balance figures from China, or the Eurozone finance ministers meeting. All right, you have to be able to establish whether the event risk is important and market moving. Okay, that is going to be our first round of test. If I'm talking about a Eurozone finance ministers meeting versus a second reading of, let's say, a lesser economic indicator in the Eurozone, we'll say Portugal GDP, which of those two has the higher optimal scenario impact on volatility? This taps into far more important constructs of the fundamental backdrop, and thereby, if we have let's say, a surprise from this, or a major development from this particular meeting, it's more likely to have a greater influence over the euro than, let's say, a surprise in the final revision of the Portuguese GDP report. All right, so that has to be our first requirement. That's our first step in assessing how market-moving event risk can be. Does it tap into the major themes? Now, for the non-farm payrolls that we had, it does. It tapped into not just risk-based trends, because we're talking about the taper speculation and the importance that the markets have derived from major stimulus programs like the Fed. All right, but it would also tap into speculation and discussion about how stimulus can devalue a currency, particularly against its alternative counterparts, like the Eurozone. All right, this has been a building and more important fundamental expectation as well. So the non-farm payrolls data certainly had the tout. It could certainly generate a lot of market activity if it is going to be a surprise. All right. Now, we have to the second requirement is to establish whether it is going to be just important or market moving. All right. Market moving and fundamentally important do not necessarily have to come hand in hand. In fact, first it has to be important and then market moving. If you don't have a major piece of event risk like a non-farm payrolls, and instead we're talking about a lesser indicator, let's say a Swiss CPI, that lesser indicator has an extremely low probability of actually generating market activity. This non-farm payrolls has great potential to do so, but it does not necessarily mean it's going to move the market. All right? It has just a probability. We also have to then see whether it is important, right? Because we did have volatility, but we didn't have the volatility expected from the non-farm payrolls. But does it necessarily mean it's not important? I hear a lot of speculation, a lot of discussion amongst economists and analysts, and certainly amongst traders, whether the taper itself and the Fed's monetary policy is important or not. Maybe it's simply not important. Maybe we are talking about a market that is going to disregard any kind of changes from the U.S. monetary policy because they're going to pay attention to the net stimulus, or perhaps they are just so set in their confidence in the capital markets advance that it no longer carries weight. Or perhaps there is absolutely no expectation that there's going to be a near-term taper. All right, that does not necessarily construe that it's going to be not important. This is very important. This is very likely in the future if we saw something like a taper and then eventually a rate hike from the United States. All right, but we'll keep it to the taper. If we saw a taper, let's say in December, let's run with that scenario. Would it be market moving for the capital markets? Would it be market moving for the likes of the US dollar index? And would it be market moving for something like the Euro USD? Yes, it would. It would absolutely be market moving. There's little probability that you would actually see a major monetary policy shift like this. The first true downshift in the stimulus program from the Fed since they started instituting the expansive monetary policy regime with their TARP and TALF and QE1 programs between them and the Treasury way back in 2008-2009. Knowing that would likely be market moving, we know that this is important. All right, we know this is important for the right circumstances. So non-farm payrolls and its influence in that bigger theme are important. And it doesn't necessarily mean that just because we didn't have that immediate bout of volatility that we won't see a development from this later. All right, that is a crucial takeaway. And the whole reason I made a particular chart that shows us the performance of the US dollar during the release of non-farm payrolls in the past. All right, you have to recall, and this goes into the third aspect of this consideration, market conditions. All right, we know that this is important, and it had a high probability of creating volatility. It did generate volatility, as I said, but not necessarily the reaction we would presume. But, and when we see that we have a non-farm payrolls release, one of the most common considerations for this particular data set is that it's released on a Friday. All right, this is the last trading day of the week. By the time you get it at 1300 GMT, you are talking about less than really or you have maybe 6 or 7 fully active trading hours left in the trading week. All right. To develop a trend into the close of the week is very difficult to do. It happens very rarely. So we see that this data comes with something of a disadvantage. However, as we can see with its release in the past, there have been numerous times where the markets have changed directions or accelerated, all right, on the release of this data. It just takes the next week when the market has time and scope to develop the trend before it really starts to take. All right, so Friday is one of the considerations. Another major consideration is that we are in the December trading period. And historically, December is a quiet period. All right, it is the lowest volume month for the S&P 500, a benchmark for risk trends, of the 12-month scheme since the 1990 on average. All right, and it also happens to be a bias towards positive gains for risk trends. All right, that too works against the outcome of the non-farm payrolls data that we had. So not only do we have a Friday release, we have a December quiet condition kind of market that typically we see is more risk on through the entire period. Right? And this also speaks to complacency. As I said before, in its scale of importance, yes, this data is important, but the expectations for monetary policy and how it has truly maintained a high level of risk seeking in the market, that kind of expectation has been so deeply ingrained that it does keep the markets buoyant unless there is a substantial change in mentality. That's the kind of event risk that could potentially fully change those expectations, but it's working against other restraints. Okay, and of course, we have to respect that just because we don't have the initial one-day volatility that would help break the US dollar from this now 12-day 70 pip range or 70-point range, or drive the S&P 500 either below the 1775 floor or back above to record highs above 1810, right, does not necessarily mean that we are left without a purposeful and meaningful fundamental update. Right? We could very well see that into next week, this data has carryover influence as it shapes expectations for the dollar and for general risk trends. All right. So using the non-farm payrolls as our example, we can always go into a major piece of event risk and establish the likelihood that this can be a major market mover and the impact that it would naturally have. All right? But we are always working with probabilities. We have to establish what's the probability that an indicator, like the non-farm payrolls, can generate exceptional market movement. It's high. All right? Then you have the requirement of actually seeing a significant deviation from expectations. All right? That's a requirement. And then we have to see the market forced to reprice to acclimate to those fundamentals. All right? And then we have to see the market conditions to support it. All right? You can only do so much in terms of establishing the expectations and putting out the scenarios for the trades, but then you have to look for the markets to actually fall in line. Sometimes the scenarios are incorrect. Sometimes our assumptions just don't play out. Sometimes the backdrop fundamentals change. But in the scale of probabilities, we can definitely lay out good expectations, and we have a lot going forward to look forward to. All right, we have the Chinese trade balance, as I said, the Eurozone Finance Ministers meeting, U.S. third quarter net wealth. We have a range of policy speakers from the Fed. All right, we have the Volcker Rule meeting, which is going to be more of a capital market thing. We'll get into the RBNZ rate decision. All right, that's going to be a closely watched indicator. The consumer inflation expectations and employment figures from Australia. We have the economic reports from Bloomberg. Those are certainly worthwhile in terms of their scope. And then we have, through the end of the week, the expiration of the U.S. budget proposal deadline. All right, so a lot of noteworthy pieces of event risk, but we need to assess, do they meet all those requirements? We've got to take it step by step. Does it tap into a major theme, and can it be market movement? Is it important? All right, and what are the market conditions that we are working with? With this approach, we can much better assess our fundamental bearings and position, whether we're just purely technical traders and we just want to avoid or take advantage of fundamentals, or we're purely fundamental traders and we're looking to see what could potentially work against our prevailing trend, or even perhaps accelerate our existing trades. We have to think in those terms with our event risk. All right. Hopefully that helps us out with our fundamentals. I hope you guys have a great weekend, and we'll do our next Forex strategy video on Monday.